All right, let's get straight to it. The date is December 16, 2025. Global markets are in a state of turmoil. This is the briefing.
So, the central paradox we're all grappling with today is this. Why is the prospect of peace, good news, right, absolutely crashing the market? We're going to break down exactly what's happening step by step. Okay, let's begin with part one, the deflationary shock. This is the snapshot of the chaos we're seeing right now.
Look at this number. This is what's flashing across screens everywhere. Bitcoin is trading at $85,266, and that marks the fifth consecutive day of a heavy decline.
And listen, it's not just crypto, not by a long shot. WTI crude oil has completely collapsed, trading below $56 a barrel. We haven't seen a price like that since 2021. And this, right here, is a key piece of the puzzle.
The scale of this drop is what's so critical. I mean, think about it. We were at an all-time high of $126,000 just back in October. We're now staring down a sharp 30% correction. Let's be perfectly clear. This isn't a dip. This is a major risk-off event across the entire board.
And here's where we see the core issue. The correlation between Bitcoin, what some call digital gold, and oil, black gold, has just hit a 12-month high. What does that mean? It means investors aren't just selling crypto, they are fleeing all risk assets. Bitcoin's fall is directly chained to oil's collapse. So that's the what. That brings us to part two, the geopolitical catalyst. What is the actual root cause of this massive deflationary shock?
And here it is. The catalyst isn't some new financial crisis. It's this quote, coming out of the Geneva summit. It's signaling sudden, completely unexpected progress in the Ukraine-Russia peace negotiations.
So, why on earth is peace bearish? Well, it all comes down to this number, 2.5 million. That is the estimated number of additional barrels of Russian oil per day that could flood the global market if sanctions are lifted.
This is the crucial point you have to understand. The market is not viewing this as economic relief, it's seeing it as a supply glut shock. The market is now aggressively pricing in a rapid collapse in inflation, and that is triggering deep recessionary fears. The good news is being interpreted in the worst way possible.
Now this brings us to our third section, crypto's liquidity crisis. Let's drill down into how this huge macro event is specifically hammering the digital asset space.
What we're seeing is a market that is completely divided. I mean, it's a total tug of war. On one side, you have the institutional fast money absolutely rushing for the exits. The spot Bitcoin ETFs just saw their largest net outflow since November. We're talking $358 million. And technically, the dreaded death cross has now been confirmed. But on the other side, you have the committed bulls like Michael Saylor doing the exact opposite. MicroStrategy just announced another buy of over 10,000 Bitcoin. He is making a massive bet that this deflationary crash is going to force the Fed's hand.
And this huge divergence, it is causing absolute panic among short-term traders and retail. The Fear and Greed Index has plunged to just 11. That is a textbook reading of extreme fear. The retail market is capitulating. So this, of course, leads us to part four, the Federal Reserve's trap. Because this deflationary shock puts the central bank in an incredibly difficult position.
Let's just walk through the timeline of how they got here. Back in November, unemployment ticked up to 4.6%. So in response, just last week, the Fed cut rates by a tiny 25 basis points, but then signaled a pause for 2026. They've essentially created the worst of both worlds, a slowing economy with a central bank promising to keep things tight. And this is the trap. It's simple. If these deflationary pressures from collapsing oil prices keep up, the Fed simply cannot hold its hawkish pause stance. It's not possible. They will be forced to reverse course and start pumping liquidity back into the system, and probably much sooner than they want to. So, the big question is, where do we go from here? Our final section, the strategic outlook.
Essentially, it all boils down to two primary scenarios that investors are watching right now. In scenario A, deflation wins for the short term. Oil keeps falling, the S&P 500 enters a real correction, and Bitcoin likely has to test that $74,000 support zone. But in scenario B, the Fed panics. We get a really bad jobs report, it forces them to signal emergency liquidity, and that triggers a sharp V-shaped recovery for all risk assets.
Which brings us to the ultimate question, the one that defines this entire moment. Is the market going to be controlled by short-term deflation or by the inevitable currency debasement that always follows a central bank panic? Which one plays out first?
Remember, this content is for educational purposes only and does not constitute financial advice.